Welcome back. Tonight we're looking back on this week's roller coaster on the markets, the dramatic swings we've seen, almost too many to mention. It all began when the US Fed Reserve sounded a cautious note on interest rates on Wednesday night. Now, in the weeks before, there had been a strong speculation that the Fed would actually look at raising interest rates as early as June, and that led to a rally on the dollar. But after Wednesday's announcement, the dollar thumped down, giving some relief to our weak rand. Today, the effects are playing out still, gold hitting a new 2-week high. Well, to discuss the week that was, we're joined by Rob Price from ETM Analytics. Thank you for joining us,
Thanks
Rob.
for having me.
So let's start with the downgrade of Eskom by S&P yesterday. And there seemed to be a little effect on the rand, but maybe a bigger story playing out globally. What do you think?
Yeah, I mean, there was a little bit of impact on the rand, but with the rand, at the moment, it's very much a global story. And as you rightly referred to, it's very much about the Fed and what's going on at the Fed. And the rand is fundamentally fragile, and domestic policy is a concern. It is a driver of the ongoing weakness of the rand. But, on the week, it's very much about the Fed. And as you said, there was a slight change in interpretation of what's going on at the Fed. As far as I'm concerned, there doesn't need to be too much of a change in interpretation. Yes, they downly revised their growth forecast, so that's something to take note of. They're not as confident about economic growth. And the Fed chairwoman, Janet Yellen, said that they're going to be less patient on raising interest rates, but at the same time, she said that doesn't mean they're not going to be impatient. So as far as I'm concerned, there's not actually too much change there. All she's actually
basically
done is
confusing people.
I think it's very much that. All she's done
but
is
aren't
mean
they quite
that
careful not to confuse the market? They've got to be so careful about every word that they say.
You're exactly right, and that's exactly what they try to do. Their whole job is to try and not be confusing, but because they've conducted these such outlandish policies over the last few years, they've made everything that they do and every step that they take so important. So people now place so much emphasis on every little move that they do. And these comments this week, all that they mean to me is now every single US data release that comes out, economic data, is going to have that much more emphasis, which means more volatility in financial markets, more volatility on FX and the rand going forward, and not too much else.
So the seesaw will carry on, because we saw the dollar finally go down, the rand strengthen, and it strengthened quite a lot today to 12.09. So we're heading back to 12. But you say the seesaw will continue, because the good news means an interest rate hike, bad news means they'll hold off, basically.
Yeah, and so in the short term, the current sentiment in the market is that they might hold off a little bit longer. But as I said, if we see a strong data release in the coming week, if we see payroll strong next month, that's likely going to mean more dollar strength, pricing in rate hikes again, and the rand's going to move in that direction. I think the important thing to place emphasis on is that these policies that these central banks have conducted are so strange that they are now producing quite peculiar reactions in financial markets, and that's a concern.
Because like you say, every single data release is important. Just explain the overall impact. So the dollar rallied because if America raises interest rates, it becomes more attractive to foreign investors. If you look where their interest rates are, though, it's still down here. We're up here. We still should be more attractive. Explain how investors think when it comes to interest rates.
Okay, so with any kind of investment, you've got to analyze the risk and the return profile. So with US yields, US bond yields, they're considered very low risk. In fact, in some economics textbooks, risk-free rates. I mean, I wouldn't regard them as risk-free. There's still an element of risk, and that's why you get a certain amount of yield. But you've got to have, you've got your return, which is about 2% on the 10-year, and there's a certain amount of risk. With South Africa, there's a lot more risk baked into that. So when you're lending money to the government, there's more risk that the government won't pay back because the government here is not as solvent. There's still concerns, and there's a number of different reasons for that. But clearly things like Eskom and higher taxes, concern investors, and that leads to higher bond yields over time.
So any closing of that differential makes us less attractive, makes America more attractive.
Well, a widening of the differential. So if they hike interest rates, that means a higher rate that you could receive on the bond yields, and then it's slightly more attractive to move your money back into the dollar, back into the US. And the reason why the US is so important is because it's the global reserve currency of the world. And post 2009, we saw a massive increase in dollar credit, and a lot of that dollar credit, got itself into financial markets all around the world, including South Africa, but all over the world. And now that we're seeing that credit environment tighten up a little bit with tighter, higher interest rates, that credit's starting to flow back to the US. And as that capital withdraws, that has negative impacts on South Africa as well as other emerging markets.
The idea right now, Rob, is that America will be raising interest rates at some point. Could that even change? I've just been watching. It seems crazy in the last few months how expectations can change so dramatically. So America wants to control inflation, but in other parts of the world we have this risk of deflation right now.
I think you raise an incredibly good point, and I think the U.S. economy is perhaps not as strong as the Fed would like, and we saw that in their downward revision to the growth forecast. So because it's not as strong, I don't think they're nearly as confident about raising interest rates. But quite interestingly, I think they've almost painted themselves into a corner where they might have to think about raising rates, and that might not be quite what they want to do, considering how weak their economy is, and particularly the global economy. The U.S. economy is not an island. It can't just grow indefinitely if everywhere else in the world is slowing. And it's got major trading partners in China and Europe that are in recessionary economic environments. So yes, I think the situation is fluid and it could change. But at the same time, the Fed has painted itself into a corner, and it might have to go down this route, and that risks incredible, volatility in financial markets.
Because of this volatility, and we see commodity markets are crazy as well. There's conflict in parts of the world. We don't know what's going to play out. Some people come to me because I'm a business anchor and ask for advice. Where do I invest? And I just think the market is so scary at the moment. Do you think that really, unless you really know what you're doing, just stay away?
Well, I'm not sure that's entirely the right approach. I think these central banks are so concerned about financial markets that they almost have they're almost an insurance mechanism, and they're trying to continue to prop up these financial markets. So, I mean, it is scary. I can understand that for first-time investors, but there is a risk of a correction under the current volatile environment, no doubt about that. But also, perhaps even more important thing for first-time investors to bear in mind is that they need to invest for the long term. They shouldn't be looking to trade the markets on a day-to-day basis. They need to enter and look to reap those returns in a couple of years' time when the markets will probably be higher.
So don't freak out. Thank you so much for your analysis. That was Rob Price from ETM Analytics. Well,